Inflation continues to give the stock market a scare. Hello and thanks for joining us this week for the fastest 4 minutes in finance. I'm Scott Inman. Well, prices continued to creep higher in January at a little stronger pace than economists and investors were expecting. From January of 24 to January of this year, consumer prices rose 3%. That's up from 2.9% the previous month. And that's the measurement of the CPI, which stands for the Consumer Price Index. It is the broadest measure of inflation and includes more volatile prices like that of food and gas. In fact, that's what drove much of the price surge. Egg prices leapt 15.2%, but that's been blamed on a bird flu outbreak. Bacon jumped 4.1%. Gas prices were up 1.8%. Now, according to AAA, regular unleaded is averaging $3.14 a gallon nationwide, up from $3.06. Month-over-month CPI was up 0.5%, and that is the largest jump since August of 2023. The stock market stumbled out of the gate as investors digested the inflation data and began to speculate what it means for the two planned interest rate cuts the Federal Reserve had forecast for this year. The data may sway the Fed to delay cuts more, and the market wants those rates down. But is the inflation data much to worry about? As we've stated many times on the Fastest Four, even though the Fed wants an inflation rate of 2%, even at 3%, inflation is at the historical average. It's not high. What is high is the cumulative effect over the past 4 years. According to a report from USA Today, prices are up about 20% now than before the COVID-19 pandemic. When prices began spiking in 2021, it put serious pressure on consumers. But as inflation has cooled, wages have increased at a faster rate than inflation. The Hamilton Project, part of the nonpartisan Brookings Institution, has an interactive data tool on its website that allows users to compare recent wage growth and inflation. And it shows that while there have been short periods when prices were rising faster than workers' paychecks, overall, since 2019, wages have outpaced inflation. So it stands to reason as long as that keeps happening, consumer spending will remain strong, which would keep the economy chugging along. But those are overall general numbers. Where things get more concerning is looking a little deeper. First, wages haven't kept up with inflation for everyone. Lower and middle income workers haven't been able to keep up, and some prices have been more inflationary than others. Housing prices, for instance, are up more than 25% over the past 5 years. That takes its toll not only on lower income workers who spend much of their income on food and housing, but also on younger Americans who are trying to afford their first home and don't have equity from a home they are selling to bring the borrowing costs down. Bottom line, we all have different feelings about the impact of inflation. USA Today reports that a closely watched index of consumer sentiment is at its lowest mark since last summer, and a Wallet Hub survey found that most Americans don't think their bank accounts are keeping up with inflation. It is a constant battle that will always be with us. Thanks for watching.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.